Our next guest is known for being bullish on the market. He says fears fueled by the so-called new normal story have produced a bear mania in stock market valuations. And joining us in Stanford is Jim Paulsen, Chief Investment Strategist at Wells Capital. Jim, helping to oversee something like $340 billion in assets under management. Jim Paulsen, thanks very much indeed for joining us. First of all, you put a lot of store into this idea of, I think it's a 1970s valuation tool called the Rule of 20. What is that exactly?
Yeah, it did come out of the 1970s. Basically, what people found in the high inflation years of the 1970s was that if you took 20 less the annual rate of inflation, it would trace out pretty reasonably what the price-earnings multiple on the overall stock market was. And this worked very well throughout the 50s, the 60s, certainly the drop in P multiples during the 70s, and then the surge in P multiples that occurred as inflation dropped into the 1980s and even up through the early 1990s. It basically says that at zero inflation, the maximum multiple you get is about 20 times, and that's been the maximum historically going back over 100 years. And then point for point, every time the inflation rate goes up a point, you lose a point in multiple. That's been a pretty good gauge. It really came apart starting in the middle 90s because of the new era mania that was around the dot-com, took multiples up to 35 times earnings on the S&P 500, when at the time the Rule of 20 was saying that it shouldn't go any higher than about 19 times. But the interesting thing, once that mania ended, Rishaad, the stock market valuation fell right back to the valuation suggested by the Rule of 20. And
so you had the idea of the mania. You had the idea of the mania in the 90s, so that created a new normal. I remember those days when everybody was talking about a paradigm shift, and you could have growth endlessly, it would seem, at that point. But of course, it all ended in tears. So we went back to normal, which was the old normal.
Yes. And I would argue today, the Rule of 20 says the market with about 1% inflation in this country should be selling around 19 times earnings. And actually, it's selling closer to 13 or 14 times earnings. And I think that big differential is a new mania, if you will, only just the opposite today. The mania is new normal. That is that we're going to not grow at all for years to come. It's almost the exact opposite of where we were in 2000 when we were going to grow at supercharged rate for forevermore. I think it's the same mania in reverse. It was a bull mania in 99, 2000, and it's a bear mania today. And I think in both cases, the bull mania suggested tremendous risk as the market was valued way above Rule of 20. And today, I think it suggests tremendous opportunity as values are way below Rule of 20.
Jim Paulsen, okay, this is obviously a new mania, but it's a new depression almost in terms of the way that you look at stocks in terms of a bear. But how did you get over this risk-averse climate that is prevalent and dogging equity markets?
Well, I think one thing, Rishaad, is it's the attitude of the day where I think conditions are really better in the United States and globally than how we are perceiving them. I think we're a globe, if you will, an investment culture has developed that is suffering a little bit from post-crisis psychosis, if you will, and all we see is bad, when indeed there's been a global recovery now for a year and a half. In the United States, that recovery thus far, at least in terms of its first-year growth rate, for example, is better than the last two in this country, better than the early 90s and the early 2000s. Profits are spectacular. We've got this whole new part of the globe called the emerging world, which we never had in the entire history of the United States, which is Warren Buffett just said earlier, is booming. And so there is some very good things, but the attitudes are so low and depressed. I think that differential between where people perceive things and where they actually are is where the opportunity for investors lies. And probably the answer to your question of how do we change that, it's just going to take time. Already a year and a half recovery. If we go a couple more years and we're still growing, I think slowly greed will start to trump fears.
Jim Paulsen, thank you very much indeed for joining us. Jim Paulsen there from Wells Capital, joining us from Stanford University.